I ask Dan Freed from YFM Equity Partners to come up and give us his experience of deal structures. Welcome, Dan.
Thanks, Adnan. Good morning. Morning, everyone. That was a really interesting presentation and loads of key themes there and background, etc., which is really good because I then keeps my slot a lot shorter actually, which is great. And I guess the part that I want to hone in on, there was a sort of couple of lines midway through James's presentation where he said they paid 50-something million for the business, that's X times EBITDA, and they had 68% management, the founders rolled over for 12% and we had 20%. And what we're going to talk about is actually what does that all mean when we get to that point in the deal. And as Adnan said at the beginning, I'm giving some sort of real life examples of two current investments that we're in. And in terms of where we invest, it's probably the stage before James's transaction with ECI. That's where we would typically look to exit an investment. So we invest at a much earlier stage in growing businesses, and hopefully the sort of process that he outlines is the ones that we come to the end, mark the end of our journey. So in terms of YFM and who we are, very quickly, because no presentations are complete without a pitch to you. So we've been investing in small businesses in the UK for 37 years. We've got offices across the UK, London, Manchester, Leeds and Birmingham, and that's because businesses of good quality SMEs are based all over the country, and you need to be close on the ground. And as Adnan said, we've been a sort of big part of that PE journey over the years in the UK. And private equity has created a lot of value in businesses, promoted businesses in the UK and internationally, created employment opportunities, and has been a real good success story. It's part of the funding landscape, and it's here to stay. And as a firm, we manage sort of 250, 300 million of funds. But what do? We invest in scale-up opportunities. So we've got growth and development capital funds that invest in businesses typically making $1 million, $2 million of revenue, who've got a great growth plan. And that is where we put funding into the business to help them achieve that growth plan. We do a lot in sort of software and tech-enabled businesses in that space. And that's typically backing businesses that are looking for the national or international rollouts, taking a new product to America, as it was in the NPM case, or in other cases worldwide. We also work on new product developments and just diversifying into new markets and territories. So we back businesses and back teams, back people to achieve those plans. On the private equity side, we invest in more established and mature SMEs. Those are businesses typically, say, 5 to 20 million of revenue, making around about $1 million or so profit, but with a really good plan to grow from sort of 1 million to 3, 4, 5 over a few years. And that's where we come in to help teams achieve those plans. And on that side, we back management teams to buy out existing shareholders who are maybe at the end of the journey for themselves and want to retire, and the management team seem a great opportunity for that business that they've been running for years. Or we can structure other deals where people have maybe invested a lot of time and effort and energy to get from startup to $1 million or 2 of profit, can see the big opportunity ahead of them, but actually want to unlock some funding to achieve that plan, but also de-risk a bit themselves. So these are just going to move into two sort of examples of deals and investments we made recently and what that all looks like. I know there's a sort of quite a mix in the audience of the room, so there's a lot of numbers. Make no apologies for that, because I was told you need to use real numbers. But it's your session to get a lot out of, so I'm not going to talk for ages through the numbers, but welcome to please ask any questions either straight after or at the end. So this is a business that we invested in quite recently in the Northwest. It was a great company it's in the sports nutrition industry, so there's protein powders, wheys, baked goods products, etc. And it was part of a large global organisation, and it wasn't core to that business. And they were going to sell it to another large global organisation. And the managing director of that business said, I've got a great growth plan for this business. I'd really like to buy it and be a business owner and not work for a large corporate anymore. And he was in the process with the next large corporate owner, and he got himself a management advisor who he said, look, I've got this plan, I haven't got much money, but how do I go about owning and running this business, owning and managing this business that I've been running for years? So what we're looking for it's very simple, actually. There's 3 dimensions we judge deals by. Number 1 is market. Is this an interesting market that we want to have exposure to? Second, really, really important, is management. Who's the team that we're backing to deliver their plan? Because we don't get involved in the day-to-day. We're backing their plan and their strategy and participate through sort of monthly catch-ups on it. So there was a good offer for this business from a trade buyer. We really, really liked the MD, and we really liked the market in which the business operates, and we came up with an offer for the business, which was close to or matched or even beat the offer from the corporate buyer. So there's two things here. There's the price you pay for the business and what's the total funding that goes into the business. To try and keep it quite simple, in this instance, we paid £5.5 million for this business at the time where it's making about £1 million or so profit. So 5.5 times multiple seemed quite a good price for us for business in this market. Then clearly there's a load of fees associated with it because, as James said, there's teams of people crawling all over the numbers and the market, etc. And then we also like to put a bit more cash in the business at the time of doing the deal to create some headroom, because you've been responsible for running the business for all this time, at the same time as you're busy Monday to Friday not running the business, getting the deal away. When somebody backs your plan, what you want to do is crack on with the plan when the deal's done, and you don't want to be back into looking at cash, looking at headroom, looking at all these sorts of things. So where does that sort of £6.25 million come from to do that deal? Well, in effect, it came from us, and also, you know, you can and sometimes partner with a bank on that transaction. So for this deal, $1.5 million or so money from the bank, which $1 million or so profit, 1.5 times multiple is pretty modest, and there's a reason for that, because as an investor, our style is, and when you're thinking about running your business, etc., you want to have as much time to focus on the business as possible. Bank debt can be good, a good way of unlocking funding to complete the deal to buy the business, but at the same time, you don't want to have too much leverage in there that you've got restrictive covenants into what you can and can't do, etc. The rest of the funding came from us, and the majority of that sort of 4.75 that we put in went into loan notes, and those loan notes are in the business and pay an interest yield, a bit like a bank debt, but they're from us, and so obviously don't have the same sort of restrictions as bank debt. And then the remainder of the money goes into the ordinary shares. And in this sort of circumstance, you can see that the management team and the managing director and his team could, for a very modest sum of money, that £40,000, can own a significant stake of a business that's doing $1 million or so profit. And in this instance, we ended up taking a majority stake. We're typically between 30% and 70% in our investments in businesses. We like to give a big meaningful stake to management because it's their business and their plan that we're backing. So in this circumstance, the management team, for an investment of £40,000, took ownership of 40% of the business. And just going back to one of James's points earlier, which I think is really important, and also at the stage we invest, we recognise that the management team, there's the core of a good team there, great MD that we're backing to deliver the plan. But going on a journey growing from $1 million profit to 3, 4, 5 million, we will need to add to the team over time. And the way you can attract good people as you're growing the business, they're attracted to the business because it's growing, good culture, good place to be, but also the chance to be an owner of that business. And so part of that 40% goes to the existing team and incoming team members who we can identify along the journey, but also to attract better talent to help grow that business and achieve the goals towards the next transaction. So that's what happens when we go in. And then what does that mean for you as a business owner? And where do you make your money? Where do we make our money? And again, lots of numbers in the screen. Hopefully you can see some of them. But what we're backing here is a plan to grow the business from $1 million or so profit to say $3.5 million over 5 years. That was the team's plan that we were backing. And again, the advisor plays an important role in terms of helping prepare that plan, the model, the stress tests, all the assumptions and everything that you need. And so if we paid $5.5 million for a business making $1 million, let's just call it a 5.5 times multiple. So what you can see there is as your profit grows, your value of your business grows. And so we're all backing a plan here that says that this is what we're going to achieve. We put in that bank debt, so the bank debt at the moment, we paid 4% interest on that bank debt, and you can see that we borrowed that $1.5 million over 5 years, and that's paying off 300 grand of bank debt a year. And then as the business grows and generates cash, etc., the cash on the balance sheet builds. And this is sort of just quite illustrative at this stage, but that's the plan. And then you've got the balance of our loan notes. So we invested the sort of 4.65 million on the previous slide into loan notes. Those loan notes we charge an interest rate on because we've got investors who are placing their money into private equity, which is obviously higher risk than banks, so it attracts a higher interest rate because we sit behind the bank. In this transaction, we charge 9%. And it's important for us because of the way we're structured as a fund. Most of our investors are high net worth individuals who are investing in committing to our fund, and they know that it's a long-term gain and that they'll get the gains at the back end. But it's important for us to be able to pay them some sort of cash yield along the way because it's part of the sell to them, and also they don't like to crystallise dry tax charges and start paying tax on interest that's just been rolled up into a loan note rather than they can see and touch the cash. So we're paying the bank 4% for their money. The business is in effect paying 9% for our money. And what this just shows is that actually each year as the profit of the business grows, the value of the equity that's sat behind that debt also grows. So at the outset, at the time of the deal, there isn't much value to that equity because of all the money that sits ahead of the management team's investment. But as you can see, each year, as you get to sort of 2, 3 and 3.5 million profit, management's 40% for a very small outlay at the beginning goes to sort of 2, 3.5, 5, up to sort of £8 million of value. And spread amongst the whole management team, that's a significant gain and reward for delivering on a plan. So how do our returns work and how do we look at it at the outset? So in effect, if the business delivers on that plan, and let's say it gets to 3.5 million after 5 years and we sell it for 5.5 times again, which is our assumption when we're modelling. Now actually you'll know that if a business has grown really well from 1 to 3.5 in a great attractive market, you can get more than 5.5 times and would expect to. And that again is additional upside that means the management team pot, rather than being 7.9 million quid, could be a hell of a lot more. But let's just stick with the 5.5 times here. So our stake worked on exactly the same way as the management stake. Our 60%, if theirs is worth 7.9, ours is worth 11.8. So you can see that we've initially invested £4.7 million at the outset. Our stake is then worth 11.8 at the end. We get the interest on the loan notes each year, 400,000 a year as we go along, and then we get sort of 4.65 our loan note principal back at the end of it. So for our 4.7 million pounds we've invested, we end up with 16.9 million at the end. Plus the 400 grand a year. So we made 3.9 times, almost 4 times our money. So that's a sort of good target if management plan's achieved. So what we've done there is you can see that management have invested £40,000 that turns into 8 million. We've invested 4.7 that turns into 19 million. So I know there's a lot to take in, and once that's sunk in, we'll talk about another sort of structure. So this is a business that we invested in 2 years ago. And it was a business in an interesting space. It's in contact centre management and unified communications. And so what this business does is four guys who worked in the industry for a number of years got together and set up their own business a few years ago because they said actually there's an opportunity here to be a good managed services provider for medium-sized call centres. So these are like 200-seat call centres, clients like North West Ambulance Trust, Lancashire Police, central government, local government and enterprises. And it's a market that's grown nicely, just fueled by the move from on-premise kit to the cloud. And the business, they started it up, it was growing quite nicely, probably got to, £700,000-800,000 of profit in a growing market with lots of private equity interest, lots of consolidation, and they got an approach from a trade buyer, sort of thing we were talking about before. And they were going through the process, and they had the market DD and the financial DD and all the legal DD work streams going on, and doing all those management presentations to the potential buyers about how great the business was and all the growth prospects. And the 4 founders turned around to each other and said, we're not that old, and we can see a great growth opportunity here. Why are we selling to somebody now for this sort of amount of money? And their advisor said, well, actually, look, you've got this approach. You told us you wanted to do the deal, so we've cracked on with the deal. But yeah, I agree. You have got a great growth plan here. You're a very credible and backable team, and there's a great opportunity for you here. So the advisor helped them through the thought process of, well, what is it you want to achieve? And what they said is, well, actually, what we'd like to achieve is maybe a little bit of money out, because we've not been paying ourselves much over the years and been working all the hours to grow the business at this stage, so it is worth something that somebody wants to pay real money for. So if we can get a bit of cash out to pay off the mortgage and sort a few things out personally, that would be really helpful to us. But actually, we really back ourselves to continue and grow the business. So off the back of that, the advisor said, well, in this sort of size and space and the growth plan that you've got to grow the business strongly, I think it's right for a private equity type deal, to bring in some private equity investment to help you achieve that. And that's what they did. So the shareholders between them took £3.5 million pounds out when we invested. And we also said, look, there's another £1 million of value today that we will defer towards to the back end. And then there were some sort of fees to pay for the arrangement fee of the money going in and all the deals and the legals, etc. And that money was funded essentially by £3.5 million going in from us to fund the £3.5 million cash out. Now there's some additional numbers in there which I'm not going to explain the intricacies of, but I wanted to leave in to show this is a real life example rather than just an illustration with some nice charts going in the right direction. So in effect, we invested £100,000 into shares and £3.4 million into loan notes. £3.5 million we wrote a cheque for, £3.5 million hitting the account of the business owners. So we liked the market growth opportunity. We really liked the team and their plan. We backed them, and we thought, actually, this deal works for everyone. They still retained a majority stake in the business. We came in and took 38%, and they owned 60%, and the other 2% went to a non-executive chair that they identified and brought to the business to chair that business, someone experienced in the industry, and help them through the growing pains. And we didn't put any bank debt into that business because they had a growth plan, working capital swings, and actually the business owners had managed that business so far without any bank debt, didn't want bank debt to come into the business to help them achieve their plans. So we invested all of the funding requirement at that time, which gives the business a lot more flexibility, opportunity to refinance later, etc. So similar to the last one, how do they make money out of this? So lots of different ways you look at it, but if we paid them £3.5 million for 38% of their shares, basically the business is worth about £9 million. And the offer they had was not far off that. So at the time of the deal is making sort of 800 and whatever thousand pounds of profit, and we backed their plan where they said, look, we can grow it to 3.8 million over 5 years. Now actually the plan has gone a lot quicker than that, which is good news. And again, applying the multiple, you can see how the enterprise value grows over time. There isn't any bank debt in there. Our loan notes are paying 9.5%. Again, that was the rate agreed on this deal. I think that generally speaking, for private equity investment, loan notes are 9.5%, the sort of figures we gave you last time. And then there's the shareholder deferred, the £1 million at the back end that they've also got a little bit of interest paying on. So what you can see there is that we put in £3.5 million at the time of the deal, where it's valued about £9 million. And the business is executing on its plan, and the shareholder equity, whereas they could have cashed out for whatever number it was they were offered from trade on day one, they've taken some money out at doing the deal, and they're seeing their equity value grow as they still own 62% of that business. So let's look at what it means for the shareholders. So the shareholder proceeds, the bottom line there, they could have sold the business for, I don't even know what the offer was, I think, let's call it around about £10 million. And what they did, they get £3.5 million on day one, plus a little bit of the cash that's in the business efficiently a year later, tax efficiently. So they get £4 million up front. And then they execute on their plan and they exit. And again, let's just assume for 6 times. Now this is an industry with this sort of growth and these sorts of profitability numbers, the multiple will be higher and they will be getting a lot more money than this. But let's assume just at 6 times. Then you've got a business there where they got an offer in for around about 10 million, could have exited. they've taken 4 million, and then potentially there's a payday of another sort of 17.5 million down the line for them. So that's why this team backed themselves to do a deal. Why did we like the deal? We liked the market, we liked the team, and for us, it was a way you can put £3.5 million into a business, get a significant minority stake. If they deliver on the plan, then we could be looking at a sort of 13.5 million at the end of the day. So again, not dissimilar to the last example, off the management plan and the management case, if they deliver the plan, then a sort of 4 times return for private equity, which is pretty good. And I think that in terms of investment returns and what we're looking at, over the long term, we're delivering around about 2.5 times to our investors. So we recognise that actually not all plans go exactly like that. As James's chart showed you, that sometimes there is a flat year post-deal. A lot of our investments do, because we invest for that growth to execute the plan over the 3 to 5 years. And we're pretty supportive as a shareholder to work alongside the management team, because we know there will be bumps in the road. Things don't go according to plan, and actually you might not always achieve this plan, but if you get a good way down the road with it and get towards those sorts of numbers, then you can see how, okay, we might not get the 4 times return we were targeting, it might be a bit lower, and that's still a good return for our investors. And actually, if the management team don't get 16 million when they exit, and it's more like 12.5 million, it's still better than the deal they would have done at the outset. So I know there's a lot of numbers there, and just an insight into a couple of structures and what it all means in terms of the numbers. So one example we gave you was a management team buying a business without putting much money into it, because that was the circumstances at the time. And then the second one is how, if you a business owner with a good plan, but thinking actually, how do I go about achieving this plan, a sort of capital release structure that can work. Yeah.
Would the advice there, looking at that, not be to wait 5 years and take the whole lot?
Would the advice be to the shareholders to wait? Why do something now and dilute down from 100% to 62%? Now, so it's a really good question, and a lot of times business owners will want to do that. Now, it comes down to personal preference, and the advice from the advisor might be different. It is very much circumstance dependent. I think in this circumstance, and this is actually a lot more of the sort of growth capital deals that we do. We put where the money does go into the business. So a lot of the time there will be a plan where a business is doing quite nicely, got a nice plan that they can fund themselves along the way. And actually, there's 2 ways you can look at it. A smaller slice of a much larger pie is attractive to people. They can take make a lot more money in the long run. Yeah. There's also the cash out in this instance on day one, where the person who might work for them. And I think it's not just about the sort of numbers. It's actually, how are you going to get from A to B? And the advice might be, well, if you think you can do it all on your own, etc., then great. Probably not right. What private equity investors bring is we support the board, we help with the strategy, we can add to the team along the way, and we've got experience of growing businesses and taking businesses through the growing pains, because it's not easy to grow a business from £1 million profit to £3-4 million profit. You'll need to change people along the way. There's a cultural shift. It might involve entering new verticals, new sectors, new markets, etc. And if a team has got confidence they can do all that by themselves and deliver that plan by themselves, don't need any funding, don't want to get any cash out, then the advice would be crack on and do it yourselves. But I think this is very much a numbers focus, but it's all about the people. And the advisors that you work with and the private equity investors they introduce you to have got a track record of helping businesses on this growth trajectory. And so what might happen a lot of the time is people will look at the idea, is PE for me? That's the question. Now, it might not be for you, and hopefully if it's not, you've learned that from this session. But what can also happen sometimes is, well, I don't know, it's not really for me, I think I can do it. Then 2 years later, that business is sort of not getting the traction they thought it could, because they've grown nicely over the first few years, but then it's not always linear business growth, and you will hit a sort of wall at some point, and it's how you take that step change to grow the business, professionalise it, take it up the next step. And then they could come back a couple of years later and say, you know what, we did try doing this on our own, but we do need some help. So the advice is case by case, It's not going to be right for everyone, but it will be right in a lot of circumstances.
Thank you, Dan. Dan, we'll have to stop you if you stay up here. I think one of the observations I'd like to make quickly is that there's no such thing as a bulk standard MBO. There are vendor-initiated, vendor-supported, FAMBO, BIMBO, and every other kind of MBO. So the message I want you to take away from today is there's no such thing as a typical PE deal anymore. Every deal is different, and Dan's just illustrated YFM having a very flexible approach to the plan. Some of the mid-tier PE firms, some of whom are in Manchester, majority of whom are in London, are less flexible, but they're having to become more flexible because, frankly, the best deals can choose between who backs them. The best management teams, actually, sorry, not the best deals. Yeah, Dan, do you want to just comment on how deal structures have evolved in the time that you've, all the different range of deals and management teams? One of the comments I wanted to make, actually, your example, the second example, gentleman there raised, would the advice be, I think one of the things you can do as a founder, let's say you found a business, and actually you don't need that much external capital, but then how do you bring in the people that you need? How do you retain your brightest people unless you have an event where you start cutting them in? And the real future of that business is not about you. It's not about the people that built the business. And sometimes you bring in funding, a private equity transaction, or some form of soft, what I call a soft MBO. You bring it in because you want to lock in the talent now. How are you going to motivate those people to stay and not leave your firm or your business? So that's also a reason to do that deal, Dan.
Yeah, that's a really good point, and it also ties to how deals and deal structures have changed over the years. So if I go back, there's a wall of private equity money out there today for sort of deals in the mid-market, in the sort of investors investing 10 to 50 million of equity in those sorts of deals where the business has got the critical mass and all the numbers, etc., to support them. And at the smaller end, there's plenty of opportunities out there. There's lots of good houses out there, and for the right market opportunity and the right management team, we will find the right structure, and we can be very flexible around that. And it really is understanding the team and the shareholders and the goals that people want to achieve and get the right structure for that solution. And that's some structuring ideas on our side, but also with the advisors who really know and understand their client and what the most appropriate structure is. And one of the reasons, if we go back sort of 10, 12 years ago in the global financial crisis, when there was less funding available and a lot more scrutiny over plans and a lot more hard to evidence how you're going to get all this great growth when there's a global recession going on. And there were quite a few transactions done then which were transactions to crystallize a value, where a sort of new company came in and bought the shares in that company for a certain price. And those shareholders who were, say, closer to a retirement age and couldn't exit the business, what they did in effect was say, look, my business is worth 5 million today or 10 million today. We will create a structure whereby that's the value for the business. We will create these loan notes like a private equity house creates loan notes, but those we'll play private equity house, we'll play bank. And those loan notes are owed to us as the business owners, etc. And will yield us some money along the way, because it's a good home for our money because we know and understand this business. But we recognise that you, the management team, who are responsible for delivering the next phase of growth, we want you to then be business owners. So once we've crystallised that value, as you grow the business above that value, your ownership stake will kick in and your value will kick in. So there are all different ways you can do that. You can do that with bank debt. You can do that with private equity money. You can do it with the vendor playing, the shareholder sellers playing that role as well. And there's a mix and match between those threes in the structure, where people sit, and what they want to achieve out of it. If somebody, if cash and day one cash is the priority and the focus, as it was in the first structure, because it was a corporate seller, the corporate seller just wanted clean exit, all my money on day one, nothing else. Then it comes down to cash. But obviously, it's different on a case-by-case basis. And with owner-managed businesses that have done well and grown over the years, brought in some people, there are lots of different transaction structures. And as Adnan said, there's management buy-ins, management buyouts, there's all different ways of structuring them. That's a separate session, that sort of teaching. But I think it's important to get an insight into the art of the possible and how things can work. And actually, that buyer-seller dynamic is important, because you're switching from sort of selling the business to becoming a buyer. But if everyone's bought into the same story and the same journey they want to be on, then the buyer and the seller shouldn't be that far apart. And the trick then is finding the structure that works for all parties, as opposed to being all about value.
Thank you very much, Dan. Thank you. Some great points there. Thank you very much.